so we have some more privacy.
Yes, it's just, I think you should update.
She's
a right to know. By the way,
I
I still think I should send that whole email I sent you to all the partners. We're all entitled to know, right?
Wait,
Whoever I'm sorry, whoever's speaking, you're live. Not a complaint, just let you know.
Sorry, we can't hear anything online.
So can you hear us now?
Yes, we can hear you now, but we haven't heard anything up till now.
Okay.
Yeah, you were on mute.
Yeah, your microphone is muted. Oh, was it? Yeah. Okay, thanks. Yep.
Actually, we can't hear the meeting. We can hear you, Lisa, but we can't hear the meeting. The
They
CTN
can hear me
microphone is muted.
meeting. What meeting was it?
I don't know if anybody can text them.
I can
Okay, I
hear
think we
you.
solved the issue.
Okay.
Oh, you did? Okay, great, thanks. I thought it was on my end, so I had my IT person come. Thanks.
You want us to back up a little bit? I think we're good. So, our thoughts as we were putting this presentation together were really about the heightened risk and as markets tighten, what that's bringing to our audience and our client base.
Yeah, and a lot of it, it dates back to probably the early 2010s. A lot of regulatory changes that have occurred since the early 2000s until now. And what's happening is a lot of organizations are feeling pressures of reduced coverage or not really many options out there for a much higher premium than they're used to paying.
It's becoming harder and harder to navigate this space, right, where there used to be a bunch of options for a lot of these organizations, for insurance carriers. That's becoming slimmer and slimmer, and that number of carriers is reducing quite rapidly. So navigating the space of both social and human services become quite difficult. As James mentioned, a lot of the regulatory developments have put pressure on these. Most of the lines that we're seeing that on is the liability lines, so professional liability, general liability, and a big one is the abuse and molestation. We're seeing that becoming one of the most predominant causes of burden on our client base and out in the marketplace for social service, human service, and not-for-profit organizations on the coverages.
Yeah, and over the past couple of years, there's been a lot of pressure on umbrella limits, where carriers have been reducing the amount that they're willing to provide to the nonprofit agencies.
Next slide, please, Mackenzie. Thank you. Go ahead, James.
Yeah, and then, like I was saying earlier, some of the regulatory issues that stemmed from some catalyst events. I'm sure you guys are familiar with the abuse allegations for the Catholic Church, Penn State issue with Jerry Sandusky, Michigan State with Larry Nassar, and then the Me Too movement. When those items came to light, a lot of legislation had changed in relation to the statute of limitations, where victims were allowed to go back further than they were previously allowed to with the statute of limitation changes. And it's probably 25 to 30 states that participated in a lot of these look-back windows that were reopened. So it gave victims the opportunity to go back, 20, 30 years when they were, when they were abused or allegedly abused by some of the individuals in these organizations. And, it creates a lot of difficulty for the nonprofits who, an allegation from the 1970s or the 1960s, there's not a lot of documentation or paperwork. It even becomes difficult to find the policies that they had in place back then. And then for the carriers who have to defend them, it makes it hard when there's no information on it. And a lot of these claims are high dollar claims, and that's the reason why the carriers are reducing the abuse limits, they're reducing the limits in the umbrella and those sorts of things.
Yeah, so I think in all of what we're seeing is that both the increased statute of limitations and then the implementation of these retroactive windows have caused a lot of pressure in the abuse molestation marketplace. So carriers didn't necessarily price these products to go back this long, right? So once they have a problem or a claim that goes back to 2006, the carrier does need to cover it, but it wasn't initially priced in that regard. So moving forward, we're seeing carriers pricing these products much differently than traditionally have seen.
And then, another issue that comes up is the indemnity provisions in some of the contracts that are out there. Puts a lot of the onus on the nonprofit organization. So a state hires the nonprofit to provide services for some individuals. And if there is an issue, a lot of the indemnity provisions put, all of the responsibility on the nonprofit, even if the claim wasn't their fault, right? So, a claim could be 99% some individual's fault, and then the nonprofit, maybe 1%, they get named in the suit, and then the nonprofit has to defend and indemnify the state for all of that, all those claim dollars. And that's putting a lot of pressure on the carriers, not wanting to insure the higher limits to defend the nonprofits, because some of these judgments have been pretty catastrophic.
And continue to increase in the amount of catastrophic or nuclear verdicts that we're seeing out there. Whereas a claim that, historically would have been a couple, $1 million, $2 million, $3 million claim, we're seeing incrementally increases of nuclear verdicts over $10 million, $20 million. So it becomes even more of an issue in that regard. Social inflation.
Yeah, and a term that comes up pretty regularly with the insurance carriers is social inflation. And that is, the rising cost of the jury verdicts that are out there. Shifting legal inadequacies, the state statute of limitations increasing. So all these contribute to the increased pricing for the insurance companies.
And so the impact, again, unaffordable premiums in many instances. Carriers are exiting the marketplace. So, if we 3 years ago had a client that has a portion of their programmatic work in the foster space, for example, there's 2 to 4 different options out there in the standard marketplace, there's theoretically none today. What that means is you're getting shifted into surplus markets, which the coverage becomes typically become more expensive, and the coverage access and limits become more and more restrictive. So we're seeing many instances, and it's not just foster care, as I think you'll see later in the presentation here. The next slide is just a quick couple nuclear verdicts that James and I just put on here as examples. One is a foster claim, whereas going back several decades, was just awarded $19.5 million in May of 2025. So again, it gives, I think, a little bit of insight into how the retroactive windows and the statute of limitations can impact the awards that we're seeing in these judgments, which then trickles down to the insurance payouts, which then trickle down to the accessibility of these contracts for the nonprofit human services agencies.
Yeah, and then the second claim there is a claim that occurred in New York State with a YMCA, where there was an individual who was abused at one of the YMCA's, and you could see that judgment was a $65 million judgment. And these carriers are on the hook for a lot of that because it's on an occurrence-based form, and the umbrella, they'll claim it in for the number of years that the individual was there, and it could hit the policy multiple times. And just a little bit of background dating back to when I started writing nonprofits back in 2008. It was pretty simple. You would send in applications to the insurance company, and they would pretty much spit out a quote right away with $10, $15 million umbrella limits. And it continued like that for a number of years. I would say probably until like 2015, 2016. Once these abuse allegations started coming to light, it put a lot of pressure on the carriers, and that's when they started pulling back. Now, if there's any nonprofit individuals who run a nonprofit here, the applications, they're significant. There are 15 to 20 page insurance applications that have to be completed. The carriers want to go out and loss control. They want to see policies and procedures in place, and then they're still cutting limits down. So there's a lot of pressure on these nonprofits, and it's a lot of work to to get them to the place where they're going to be obtaining quotes from the carriers.
And on the next slide, you'll see some of the different providers or verticals in which we're seeing or having difficulty upon renewal or new business submission. So foster care, adoption, community justice, youth residential programs, daycare, Head Start programs, behavioral substance use treatment. I mean, that's becoming tighter and tighter as we speak. Group homes, residential, YMCA, boys and girls clubs, and shelters, really habitational in general, is becoming more and more tricky, whether that's a group home for community living arrangements with folks with individuals with developmental disabilities, or whether that's a sober home or things of that nature. I know we're probably going over our time allotment here, so please feel free to let us know. But I will tell you that this next page is an important one. So underwriting and carrier outlook. James, you want to hop on that?
Yeah, so one of the important factors that come into play is for a nonprofit organization to have policies and procedures in place around these items that the carriers are feeling pressure on. So abuse and molestation policies and procedures, carriers want to see a specific policy and procedure outline based on this information. I would say when we go out, 50% of the nonprofits that we visit only have a mandated reporter provision in their abuse and molestation policies. And the carriers want to see all these items here. So screening, when it comes to application interviews, background checks, that's pretty much a requirement. They even want to see background checks intermittently. So at hire, they're going to be required. They also want to see them 3 years after hire, just in case something happens at the time where the individual's employed. Trainings, they want trainings done at hire and annually. They want to have prevention in there. So 2-adult rule, 2 adults with in a vulnerable population. And a lot of times, counseling comes into play where it's a one-on-one setting. When that happens, the carriers want to see either a window in the door or a window in the room where people can view in and see what's going on in there. And I know you guys wanted us to touch base on the auto piece of it as well.
Yeah, commercial auto policies, again, MVRs are more and more requirement to run those, not only upon hire, but annually run those requirements. GPS, telematics, fleet safety programs, distracted driver policies. A lot of the carriers are now where before they do they have an abuse policy? Do they have a driving policy? Do they have a fleet management policy? Yes, they do. Check the box. Now they want to see them. So making sure that, as you underwrite or as we work with folks, we're providing some input and insight guidance as well into having those policies and procedures set up properly so the underwriting process runs smoothly. And then again, the next slide is just really kind of what we look at on an underwriting process when we're looking at insurance and acquiring quotes for a nonprofit. So we want to walk through all the properties prior to insurance carriers. We want to develop a marketing plan way in advance of that time period. We want to review the policies, procedures, and work with the organization and their management team to refine those. Review loss runs, identifying claims, patterns, reserves, things like that. And just stay on top of those things, making sure that we have transparency to the carrier and making sure that we're set up prior to engage in underwriting process.
Yeah, and one of the things is the standard market, there's probably about 12 carriers in the standard market, which is going to be like a Philadelphia Selective, Great American, Hanover, Cincinnati, those type of carriers. When those carriers don't want to write the business or they non-renew the business, then it has to go into the excess and surplus lines market. And you have carriers in those markets who are willing to do it. However, the contract or the policy is going to be a watered down policy compared to the admitted market policy. So there's going to be less coverage, lower limits, higher deductible. A lot of times it's going to go from what's called an occurrence liability form to a claims made liability form, where it's only going to pick up claims that move forward, no claims that happened in the past. And these deductibles can get high. I mean, you're probably looking at, they usually start out around $50,000 deductible per claim and can raise up to $100,000, $250,000 deductible per claim. So instead of the carrier being a $1 defense, which a Philadelphia or Hanover or those carriers would provide, the nonprofit has to come out of their pocket for the first $50,000 or $100,000 to defend themselves. And even if it's a claim that has no merit, they still have to defend themselves and make those payments for attorney's fees and defense costs. So it's putting a real strain on the nonprofits when they have to go from a standard market to an excess and surplus lines market.
Thank you.
Great, let's open it up to some questions. I wanted to start, and I have probably asked this question a bunch of times now, but since we don't meet every day, you know, I think it's good for us to ask some of these questions. So my concern, and it's kind of to the insurance department too, is when the wildfires happened in California and people's homeowners insurance in Connecticut went up, we had a lot of our constituents say, oh, we're paying because we're subsidizing the cost of what happened in California. And our insurance department said that is not possible. We do not allow them to bill the risk from another state over here to Connecticut. So there is a firewall up that our department, has in place. When I hear a presentation from you guys saying that what happened at Penn State, in the Catholic Church and other things that, necessarily were out of state, how are those incidents allowed to then jack up the prices here in Connecticut? Or make the coverage, harder to get?
Well, I'll speak to it, and Jane can probably, or Terry can also add on. Jane's our chief counsel at the insurance department, but I think when you look at situations like that, liability situations like that, the trends that you're seeing around the country, the trends that you see within, statute of limitations, they still work their way into a company's thinking about writing the risk. Can we write a risk profitably? And if they have to worry about these long tail situations with these claims, it really comes into their wondering that, do we really want to be here? And if we do, and we know that this is the potential universe of a claim that could happen here in Connecticut, we need to price for it. But we also need to protect ourselves and limit maybe the liability limits that we're writing. So there's a lot of conversation that happens within the company about engaging in a marketplace where they're concerned about their ability, to profitably write a line of business.
Could I address that point? Your Honor, this is Paul Slager.
Paul, we have two more people in front of you, and then we're coming to you.
Thank you.
Just one comment, and I don't want to not remark on the overarching 900-pound gorilla in the room, which is the reinsurance market.
Yep.
You gentlemen know exactly what I'm talking about.
Yep.
Whether it's Philadelphia Insurance one day or another carrier, they all make the journey to Lloyd's once or twice a year on the January or July reinsurance renewals, and they all get the same bad news at the same time, which is if you're in the social services business, there's the exit. And you know exactly what I'm talking about. So what's important is that while a wildfire in California may not have an immediate impact on your ability to price a package policy for a social services agency, which includes property, that underwriter is suffering through a reinsurance market problem, and you know exactly what I mean. So we will need to address at some point, Rep. Wood and everyone, the impact this has on a much larger scale, which includes the reinsurance market. If you had to price right now a brand new client, social services client, 350 employees, here in Connecticut, just picked it up through RFP. Scale of 1 to 10, how hard would it be to place the comp, workers' comp?
Workers' comp is not really that difficult in Connecticut.
Scale of 1 to 10.
I would say 8.
Okay. If you had to place monoline automobile insurance outside of a package, 1 to 10, how difficult would it be?
That's a lot more difficult.
Okay. If you had to place general and professional liability inclusive of umbrella outside of a package policy on a social service agency listing all of those things that we just had up on the board a moment ago,
Yep.
scale of 1 to 10, how hard would it be?
It's going to be excess and surplus lines market.
And in the E&S market, you're liable to get big deductibles, lowered limits, and significant hybrid model type contradictions in the policy. So we're against a crisis. Would you agree? We're up against a crisis.
In this sector, for sure.
Absolutely. Thank you.
Thank you for your presentation. I thought it was excellent.
Lisa will call on you next.
Just following up on what George and Michael is right. The reinsurance aspect is a big piece of this. Obviously, trends matter when analyzing risk from an actuarial standpoint. But it is important to know that the Department of Insurance would not allow losses that occurred in a different state to impact the premiums directly in Connecticut. So fires in California do not impact the premiums in Connecticut. And the point that I just wanted to be very clear about is the extension of the statute of limitations, which is commonly known as a reviver statute, has not passed in Connecticut. So it's obviously from a trend point, your point is well made, and verdicts that occurred in other states, your point is well made. But in terms of a Connecticut viewpoint, it's really Connecticut loss, Connecticut claims that impact the Connecticut risk and the pricing thereof. So I just wanted to be clear about that. If insurers would not include that in their premium requests, and let's say it happened in a bizarro world, the department would not accept it. That's just the way it is. Thank you.
Paul Slager?
Thank you. That's really the same point I wanted to make, which is twofold, I guess, in summary. One is there has been no statute of limitations reform in Connecticut of any significance in really 30 or 40 years. So there is no look back, there is no window that's opening. And so my question was really the same question, is why is what's happening in California and New York relevant? That was point number one. Point number two is there's been no quote unquote nuclear verdicts or runaway verdicts in the last 5 years in Connecticut that would be along the lines of those mentioned in other states, this big verdict in New York. So I think it's important that we talk about Connecticut. So that's all I had to say. Thank you.
Yeah, and specifically, we didn't really want to bring Connecticut into play here because there are nonprofits that are associated with the group that have had claims, and we just didn't know if we want to speak on that in this environment. So, some of these claims settled, and there's non-disclosure agreements and that sort of stuff. So for us to bring that up in Connecticut, that's why we went out of state to bring examples of those claims.
Rep Wood, if I may, allowed one more question. Is that
We
possible?
have a list.
I beg your
I
pardon.
will add you to it.
Thank you.
Next, we have Lisa.
Hi, folks. For those of you that don't know me, my name is Lisa DeMattis-Lepori. I'm the CEO of The Connection. I want to publicly acknowledge Brown and Brown and thank you, James, for the fight that you fought for us during the session. We almost lost all of our insurance and closed. We are a 54-year-old, one of the largest nonprofits in Connecticut. We run 50 treatment programs, and we were hit with a catastrophic and extremely large claim due to a death of someone in Connecticut, and our insurance company dropped us. No one would pick us up. James is the one who was in the trenches with us at Brown and Brown. I think, what did we have, James? 17 insurance companies that turned us down. We were at the very last moment. James pulled it through, and we were able to get secondary insurance to pick us up at the cost of almost an additional $1 million to what we currently pay for insurance. Again, I just want to thank you, James and Brown, for the extraordinary work you did. I think James and I talked every day up until late at night while I was at the LOB working with many of you, fighting this fight so that my organization would not close because of this large claim. We don't do foster care, but we have a lot of residential programs and community justice programs. And really a lot of the programs that we run, other nonprofits don't run them for community justice. So they're extremely high risk. Over the 54 years that we've been in business, we have never had a claim like this. And it's not a matter of when, but if this happens to other nonprofits. As you know, many nonprofits were up at the LOB fighting for foster care because they couldn't get insurance. But I think that what I want to say is that this is a massive problem for Connecticut moving forward. If insurance companies are going to drop, if a claim comes up, And we know that we deal with very risky clients. We have a very robust QI and best practices and try everything we possibly can to avoid any catastrophic event. But unfortunately, these things do happen. It's a part of our business, but there will not be nonprofits in Connecticut if any one of my peers gets hit with a claim close to mine or anything large, we are not going to exist anymore. So we have a massive problem on our hands. And I'm grateful to be a part of this committee. And again, just want to thank you, James and Brown for the stellar work that you did to pull us through at the very last minute.
Thank you, Lisa. Representative Meskers.
Thank you, Chair Wood. I guess it's a question and a comment regarding the national trends. I understand your comments from multiple speakers about the fact that Connecticut insurance is Connecticut insurance is Connecticut insurance in terms of premiums, risk, and the cost of insurance. But I think notwithstanding that statement, the national trend, and we can take it back to the fires in California, we can take it back to storm-related losses in whether it be in Alabama, Texas, Florida, and settlements across the country influence how underwriters are going to measure risk. So while we may not get a transfer pricing because we're not subsidizing prior losses, when public policy sets risk, it has to have an impact on how the underwriters price that risk. So if we're going to make people liable in a more aggressive way, the premiums have to go up. And I'd love a response, many of you, on that observation to see whether I'm on spot on that. And the second thing, what I haven't heard from anyone is there a way to carve out, to look at both the claims history and the risk, and to look at legislation, not that would deny people justice, but would either cap or look at mitigating the losses so that the underwriting could happen and our nonprofits could function. So those are the two things I have. I don't know if that's where I should be, Chair Wood. If I'm out of line, you let me know.
Anyone want to answer that, or we could save it for later? George?
Yeah, I'd like to just sort of, what Representative Mesker said is true, and sort of go back to Hurricane Katrina when I'd been at the department a few years, and I remember getting a reporter's question asked me, how is this going to impact Connecticut? And I told them, in all honesty, that it wouldn't impact Connecticut because it was a loss that happened in Louisiana. But what I failed to see at the time and have learned over the years is that as companies began looking at their risk throughout the country, they started to see that they had great exposure in states like Connecticut and along the East Coast and around the country. And so that began their looking at their posture about their risk appetite and what they could be ultimately exposed to with a large catastrophic loss. And then the reinsurers, as Mr. McGlaris pointed out, also started looking at the issues and their exposures. And they started charging higher rates for their reinsurance cost. And companies needed to realign their books of business because they realized they had tremendous exposure and they had to increase their pricing to reflect what that exposure could be to them, and also including what their reinsurance costs were. And so there's this whole thing that happens in the marketplace as companies begin to look at their risk. They start to assess, what it's going to cost them and what do they need in order to pay for that largest catastrophic loss that they could endure at some point. So that's kind of how things sort of, an event happens in California, but it reverberates through the marketplace as companies and boardrooms and around the country and around the world start looking at their risk and how are they going to address it.
Michael?
Is this about class of risk at the end of the day? And let me cite what I mean. We have clients in other states, social service agencies in other states, as captive consultants. We have clients in other states, Illinois, California, Texas. Not a single one is not facing this crisis. Would you agree this is a national issue?
100%.
Okay, so can we all agree that insurance companies are for-profit entities with shareholders and have a right to deploy their capital as they deem necessary? Many people in this room have direct investments in insurance companies or are insured through pension programs where there are shares in those companies. We want the insurance industry to do the right thing all the time. But let's be clear, is this not about class of business? If I have an opportunity to deploy $4 or $5 or $6 million of my capital in the state of Connecticut or the state of Wisconsin or the state of Texas, and I can deploy that capital to workers' compensation insurance or to pig iron underwater property insurance rather than social services, isn't that my choice as an insurance CEO? And is this not, at the end of the day, the fact that the folks that provide these services, these needed services, primarily for our youth, are up against a national, forget Connecticut, a national crisis where it's class of business. What do you do, Lisa, who just spoke to us a moment ago, my friend Lisa? What kind of business do you run, Lisa? Guess what? I'm an insurer, and that's a class of business I'd rather do without. Is that not the fundamental question?
Yeah, I think you hit it right on the head. I mean, insurance companies are in the business of being profitable, right? And when they're taking on the risk for some of these organizations, their combined ratios are unprofitable. And in order to bring them back to profit, they have to charge more premium. So ultimately, to do that when you're looking at this class of business, it's a higher risk, so the premiums are high, and some carriers elect to not insure that risk any longer.
And so we therefore confronted, Chair Wood, are we therefore not confronted with a crisis that it doesn't make any difference, the statement, I've never had a claim this size, or I've never had a claim. It doesn't make any difference. You're part of a class the insurance industry doesn't want anything to do with because they'd rather deploy their capital someplace else. So if we want these services done, if we want these children helped, if we want these social services consummated within our state, is it not true that we must take the bull by the horns here at some point?
Agreed.
Last question before we move to the next speaker from Representative Nuccio.
Sorry about that. Thank you very much. So I'm listening to all of this, and I have a question in regard to the risks that we're seeing for certain providers here. If we were to look at, insurance is a socialized product, right? It is an offering. We all know how all of this works in that, right? So if I have somebody who's had insurance for 15 years and has paid X millions of dollars for this insurance, but has never had a claim, how much have they paid into the pool? And if they have one claim and then all of a sudden they find themselves without insurance, are we looking at, maybe this is a question for DOI, but are we looking at this one product, right? How much are we charging for this product? How many claims go out the door? Making sure, again, that they're Connecticut only claims and Connecticut only issues, to see what is the profitability of the insurance companies in this market. Because as Mr. McGlara said, insurance companies are like any other business. They're there to make a profit. Right, they're there for their shareholders to make sure that it's a product that's being offered that people want, that people are paying for, that generates some sort of profit. But in the health insurance world, we're limited to the amount of profit we allow insurance companies with MLR. And the state of Connecticut is extremely punitive with that. The last rate review, I think it was under 1% profit was built into the fully insured rates. Do we do the same sort of thing with all different kinds of insurance, or is that just healthcare? And is that something to look at to make sure insurance companies aren't overcharging to just build their profit rather than meeting the outpay of claims and making sure that it's a balanced process?
Well, you know, I can't address the health market. I know no one can address that. It's a mess. You know, I think if you want to start controlling
Well, but I would say
profits,
the fact that
if
it's a
you
mess
want-
is not an
if you
excuse.
want to start trying to control profits for the industry, you'll see a much greater issue at your doorstep. And I don't think we want to go there.
Well, I'd say we already control profits at the health insurance across the board, right? That's already done. That's federal legislation with MLR,
It-
right? And if you're
Profit-
saying that we're going to cancel people's insurance policies, but
But-
we're going to make a 25% profit on these claims, then you're raising it up to our issue,
But
right?
profit is looked at during the actuarial process, you know, so, you know, our actuaries do look at a company's profits and what they're doing, and if they feel they're excessive, they will address that and have conversations with with that individual company in their rate filing. You know, so my first statement was not to say, you know, that we don't look at that. We do look at profit. I'm just saying if you want to try and start capping it to a specific amount, you could run into some issues. But our actuaries do focus in on, you know, potential for excessive rates, excessive profit, and, you know, look at that issue. Jane?
George, do you want to just comment on the fact that most of this business at this point is written on a surplus lines basis yeah.
Yeah, it's, yes, and, you know, I think Brown and Brown, our friends here, can vouch that what we're finding is a lot of this business has transferred over into the excess surplus lines market. And we don't have any control on, you know, those products, those rates, you know, the forms that they use. The department has no control over what the company's charging and what the, you know, what the rates are.
Would, if I may, the very nature of the excess and surplus lines market is that it is unstable. You know that, gentlemen. You actually have to get the insured to sign a form accepting the fact that they're taking into consideration a company that's not protected by the guarantee fund in the state of Connecticut. So what have I got? I got a class of business, needed social services that people need desperately. The next generation of children being raised in the state of Connecticut, taxpayers, workers, leaders who are in jeopardy. I've got a class of business that is not the favorite class of business of the commercial insurance market. Otherwise, they wouldn't be pushing them into the surplus lines market. And you know and I know, gentlemen, that a surplus lines carrier can take a little position in a state for a year or two, decide if it's profitable, and then immediately leave. This is not a broad-based solution. And you know that you struggle every time you place a package policy for a social service agency that includes general liability. You know you struggle with it. You beat up underwriters all day long, right?
Yes.
Right. So we've got a real problem on our hands. And if we don't address it, I don't mean to
I'd like to
sound
also
like
finish
we do.
my comments from my time if I can. I understand that the market is a mess, but just because the market is a mess doesn't mean that we shouldn't try to look to fix it. And I have concerns about what we're hearing and the fact that I can't seem to get that information that shows me how the direct claims, and I understand how actuarials work. Trust me, I understand the insurance business better than most people in the Capitol. But I would still like to understand if I've got years of no claims and I have a claim and I'm getting canceled for that one claim, what is happening in the market in that area that is generating that idea, right? How is the payout going and what is the profit level that is being achieved? Thank you, Madam Chair.
Any comments? Okay, we will get some follow-up for you, Representative Nuccio. I want to thank Brown and Brown, Rocky Hill-based company. Thank you. Right in my district. So it was really interesting, and we're very thankful that you came today.
Thank you for having us.
Next up, we have Alera Group, Brad Billingsley, and Brenan Highland.
Good afternoon, everybody. My name is Joanne Wright. Actually, I was reached out to in regarding this meeting. Unfortunately, I'm on the employee benefit side, so the conversation has been great to listen to and appreciate all the comments made, not only by everybody in the room, but also by Brown and Brown. In a moment, I'll turn it over to Brad and Brennan. But before we get in there, I was notified last April by 3 or 4 different agencies that I don't work with, that I just know from dealing with nonprofits on the employee benefit side, reached out and had this problem. I did reach out to the association, the alliance. They then, I believe, reached out to the state. So I want to thank everybody again just for getting together and addressing this issue. The fact that it was brought to my attention by 3 or 4 different contacts that I'm not even really working with currently was amazing. I did reach out to my national team regarding this. That would be Brad and Brandon will speak for a moment. And they're seeing this nationally. So we will, address your questions. We'll do a quick presentation and again, appreciate the time. Brad, you want to take over? Brad, you're muted.
There we go. Yeah, appreciate that, Joe. And just to kind of set the stage, both Brennan and I work with nonprofits, human service organizations around the country and on all time zones. And true, we're seeing what's being discussed, and we're working through these challenges. And there's no easy answer. And it doesn't make sense if I'm a nonprofit with a great history, and yeah, I have one claim. How is it that I'm getting non-renewed? And that's part of the challenge that we have. Brennan will share in just a moment. He's got a very unique perspective with his background. I sit on some boards of some nonprofits, large national nonprofits as well, and I'm seeing this firsthand. And hopefully we can continue a conversation with the group here and help bring some solutions to Connecticut and across the country. So, Brennan, I'll hand it to you.
Thanks, Brad, and appreciate the time with this group today. My name is Brennan Highland. I help co-lead the national nonprofit and social service practice for Alera Group. My background is I actually came from Philadelphia Insurance Company, so I come from the underwriting side of the industry, with Philadelphia being one of the largest social service insurance providers nationwide. So that gives me a little bit of perspective, and it's interesting to hear that name in this meeting today, because they are certainly one of the leaders within the marketplace, but also have contributed, quite frankly, to some of the challenges that we're seeing today. So we'll touch on a little bit more of that as we move forward. So a couple things, and much of this may sound somewhat repetitive based on what we've heard from the Brown and Brown group earlier in this meeting, but this is not specific to Connecticut, as we've heard today, but the expansion of the look back or the change in the statute of limitations nationwide. A lot of this is reflective of the conversations we had a few moments ago in regards to these statutory changes driving reactions from reinsurance carriers and willingness of carriers to produce limits in the marketplace. I don't want to dwell on some of these items as they've been expressed, or that they've been talked through quite thoroughly thus far, but we'll keep moving through this. Influx of sexual abuse and molestation claims. The rate of sexual abuse and molestation claims filed throughout the marketplace has dramatically increased, as we'll demonstrate a little bit later in this. And the need for that coverage has continued to really expand. So that is a line of coverage that has been really battered. And we talk about the profitability of these line items for insurance carriers. That is one that is quite frankly not profitable, which is a direct through line to their willingness to offer it in different venues. We've talked a lot about the admitted versus surplus lines marketplace, as has been discussed. There's been a real push out of the admitted market into the surplus lines marketplace over the last 5 to 10 years, which has just made obviously additional cost for providers and has really restricted the ability for a competitive marketplace. depending on the venue that we're operating in. We can go to the next slide, Brad. I'll turn it back over to you. You're muted, Brad.
We could just go back one slide real quick. So, a couple of comments. That movement to the excess and surplus lines market, not only is that causing costs that oftentimes go up 2 to 5 times the amounts, but the restriction of limits, the sublimits that are being applied, the need to go out and kind of get siloed coverage sometimes in order to build the limits that are needed. But it's also impacting coverage dramatically. Just a few examples where there might be an exclusion for assault and battery, should that occur at the location. Elopement, if somebody is to wander off and get injured or cause damage. Self-inflicted injury. Those are just 3 examples that we're seeing regularly as we get into the excess and surplus lines. Another big trend is moving the defense costs inside the limits. So historically, way back, it was pretty common that and we still can get it sometimes for some companies, where you have defense costs that are outside of your 1 million, 3 million, or whatever limits you're buying. But when they're going inside, all of a sudden you're eroding the limits that you have, which is creating a lot of issues. The other comment I'll make on that retro dates, this is a really, really big deal, is companies across the industry. I spoke with the head of one of the top 3 nonprofit insurance companies, the head of their claims, about a year ago, and one of the big trends was, hey, expect us to start to limit how far back we will insure legacy claims, these abuse claims that may come up. This can be a very technical conversation, but in short, they're saying, hey, we'll insure you, but we'll only go back 3 years maybe, or a year. One of the largest carriers right now is saying we'll do it at inception, meaning if we take over your policy today, we're only going to insure for stuff going forward, and that has the potential to leave gaps for those historical legacy claims, effectively leaving some organizations self-insure some claims. There's a ton that goes into that, but many organizations are facing that. So,
Brad, one item I'll add there for this group is, as the conversation around potentially exploring or creating a risk pool for organizations in the state, as that conversation progresses, this is going to be an item of focus, would be my thought, is how much liability is that pool willing to take on from a long-term or tail perspective. So if a pool is going to be considered, and it's something that is going to be available for providers within the state, what is the scope of liability that pool is willing or able to take on from a long-term liability perspective? That will have impacts both on organizations' ability to utilize that pool, and also on potentially the stability or the viability of that pool from a long-term perspective.
Cool. Next slide, please. This has been discussed, but this is, in the past couple of years, this is where, things stand across the country with abuse, statute of limitations. These things change, kind of year to year. There's some of the worst offenders, and those are the dark red, statute of limitations expanding, being removed, and somehow a combined effect on those things. The reality is that nationally, this industry it's experiencing the impact of changes across the country in many of the venues. And what it's doing is it's causing these carriers, as the Brandon Brown gentleman mentioned, it's causing a bunch of them to step out and say, I'm no longer insuring that industry. Or some of the largest carriers have said, we'll keep insuring, but no longer will we do abuse or abuse in this state, or we'll only provide one limit, which complicates the ability to structure a program, and it causes the cost to accelerate dramatically. So as this continues, we're going to continue to have a challenge in the space. Next slide. Brennan?
Yeah, a number of these have been discussed. We talked through nuclear verdicts. The gentleman from Brown and Brown provided some examples there. One item that's very much being considered in the industry right now is third-party litigation funding. I don't know that I need to talk about what that is, but happy to if it's important. That has driven large verdicts within these carriers through the roof, quite frankly, both from a size perspective and a frequency perspective. So it's essentially creating, it's when we talk to the heads of the large underwriting organizations that we work with, this is top of their list in terms of what they see driving some of these verdicts. And it's very much contributing to the social inflation issues industry-wide that have been touched on earlier. The tort law environment, we've seen some of that. I do want to keep this somewhat focused on Connecticut, which is somewhat less impacted than other venues. But for the sake of this meeting, I want to focus on Connecticut. And the contractual liability that states pass on to organizations when they do enter into contracts. So again, this was touched on earlier, but the burden of liability is typically borne by the nonprofit or by the organization versus the state participating in any way from a liability perspective. That opens up and it really puts a burden on the organizations themselves versus allowing the state to participate from a liability perspective in conjunction with the providers.
Next slide, please. I'll touch on these, and these are just a few slides that just give some outside perspective. Presidium is one of the nation's leading risk management firms, and there's just a few slides that kind of highlight what they are hearing from the carriers as far as what to expect in the coming years. This first slide shares that the percentage of carriers that expect to decline coverage or decline to write coverage for abuse in the following sectors. So child care, foster care, youth are kind of leading the charge there, youth development as well. So there continues to be a trend with carriers saying in the future, we're likely to start declining to write abuse. Next slide. And then this one identifies that 59% of the underwriters expect the market, the insurance market, to harden, costs continue to go up, and coverage continue to be restricted, limits continue to be restricted. So from the underwriting community, they're not seeing a light at the end of the tunnel, particularly in the standard marketplace. And we'll do the last one. The next one is, we'll kind of end on that. This final one just kind of sums up that in addition to not writing coverage around abuse, the vast majority, 71% of the carriers, expect that their requirements are going to increase. They are going to ask more of the nonprofits to be able to demonstrate that they're best in class, that they've got the right controls in place, and ultimately they're an organization that's worth investing in. And we've seen this firsthand, the kind of questions that are being asked of our clients, the depth that the underwriters are going into, and the history, how far back they're going, continues to escalate. And amidst all the challenges that nonprofits are facing right now, this just adds to the overall burden. That said, those organizations that are best in class, that partner with their broker partners and develop a relationship with the underwriters and really can demonstrate that they're best in class, they are not feeling, by and large, they're not feeling the impact quite the same as those that have had several claims and are just don't have the narrative or the risk control foundation in which to give the confidence to the underwriters. So that kind of concludes our thoughts and remarks, and I think there's, our friends at Brown & Brown are very much aligned with what we're seeing. Across the country, it is a crisis, And we're just very grateful that there's people like those on this meeting that are looking to find ways to make the changes needed. So we'll conclude our comments there. Thank you.
Thank you very much. If you have questions, just wave at me and I'll put you on the list. I can kick it off. Regarding the third-party litigation funding, are there any states that have put reforms around that? And here in Connecticut, I don't know if you can answer this, maybe someone from the department can. Are there any regulations around that currently?
I believe the state of Maryland either has or is in the process of capping the percentage of attorneys' fees that can be recouped via third-party litigation or third-party funding. So that's the only state I'm aware of, although there may be more.
Okay, Jane.
Yeah, so there are a number of...
One other comment to that is the lack of transparency in many of the states where it's just not clear that there is third-party litigation funding coming in, which is making it even more difficult because nobody really knows what's happening.
So there are not currently any restrictions in Connecticut law. That said, there are proposals popping up across the country that address litigation funding that the insurance department is certainly monitoring and thinking about.
Great. Any other questions or comments? Great. Thank you so much for participating today. We really appreciate you sharing your time and hope that we can continue to work with you going forward as we try to tackle this issue. Next up, we have Eric George, who has graciously decided to give us an overview on the New Hampshire legislation. Did this just come out, Eric?
Yes, it did.
Great. This is regarding nonprofit pooling.
Yeah, and also if I could just, as an aside, I'm very happy we had that third-party litigation funding discussion. I really appreciate the last presenters bringing that up. It is an important aspect. Also, I just wanted to also say that the part of their presentation talking about the limitation of liability provisions that are in the contracts of the nonprofits with the state of Connecticut shouldn't be overlooked, and they made that point, and I thought that was excellent as well, because it does impact the entire risk profile when you are also worried as an insurer to take into account the actions of another entity, being the state of Connecticut and its employees. So I just thought that those were very important. They weren't necessarily addressed in other parts today, so I just thought that it was really well done. So one of the things that I've had discussions with Representative Wood about and others is what are certain ideas that folks are having, and I did some research, and this is for educational purposes for folks just to consider, and this is not law. So just so everybody knows, but in the state of New Hampshire, very recently, they had a public hearing on a piece of legislation that would establish pooled risk management programs in 2 areas, child care centers and foster homes. It would direct their version of the Department of Insurance to ensure standards are met. And the pooled risk programs would not be subject to certain rules and regulations because in the statute, or in the proposed legislation, these pooled risk programs are not considered insurance. I think every member of the group has a copy of the bill. It's reasonably thought out. I think that this is an item for not necessarily, it's just a discussion point as we move forward. I remember when I was talking to Ben Shaken numerous times about legislation that he has tried to advance in prior years that would, if certain standards are met by a nonprofit, that they would have certain liability limit or held harmless. And I think to the extent that we can protect our nonprofits in terms of the liability exposure that they have, that changes their risk profile from a private provider standpoint, a private carrier standpoint, and perhaps if there was also a state option, if you would, a state method, that might help as well. It's a very difficult issue. We all know that this is extremely important. I need to emphasize that companies analyze and assess risks based upon their own perspectives, their market share, their risk tolerance. George Bradner, I think, did an excellent job talking about how companies will look to see what can they comfortably take on for risk while protecting their capital. Yes, they are for-profit entities. They are in the business to make a profit. But insurers also have to be mindful of the fact, and the departments of insurance are mindful of the fact, that we have to honor the claims and the promises that we have made to our policy holders. And to that extent, we need to be very aware of our capital that we're going to have to utilize to pay the claims that we have promised to pay. So when you are taking on new risk, all of that has to be factored into account. So I just wanted to mention the New Hampshire law, the New Hampshire bill, pardon me, it is just a bill. Again, its hearing was just held a couple of weeks ago, or 1 week ago on the 8th. And that's what I have.
And I mean, it sounds like from what I have read that it's very high level, basically directing their Department of Insurance to put something together. So still something to watch. It's really interesting to see. Any questions or comments regarding this, George?
Yeah, just quickly perusing it. I think some of, I think ours, if we did anything similar to this, it should be broader than just foster care, as we've seen here. I think it should be more inclusive. I think we've heard from an underwriter within a company, automobile, we saw it here, automobile is an issue for these entities as well. The costs are rising significantly, but it's worth, anything is worth looking at to figure out, what we might be able to do in Connecticut.
With that, I think it's a good transition to look at another handout that we gave everybody. I did talk to OFA and ask them to run a report for us. What would the cost to the state be if the Department of Children and Families directly operates short-term and residential care centers instead of doing so through private providers? And the answer is, assuming the primary cost increase is facility operation by DCF personnel, the additional cost to the state could be roughly $25 to $40 million annually due to the higher wages and fringe benefits compared to the nonprofit employees. So that is just for DCF operated. So if we take that number and add it to group homes, behavioral health homes, daycares, we have OEC in the room. That number becomes exponentially high. So someone did make that request.
That number becomes 100 million plus, in my view.
The number is definitely 100 million plus, and that's just scratching the surface. Yeah. So,
and what's really remarkable, when you see the $25 to $40 million, that might sound like a lot. In the grand scheme of things, it's not as much as I might have anticipated. And I am, wondering, and I think that the answer is yes. A lot of that is because the state doesn't have to worry about getting sued, because it is insulated from liability and only gets allowed, the state has to allow a claim to be brought against it. As we know, those who are on the Judiciary Committee, a claim against the state does not get approved the way I can sue XYZ insurance company, something like that, whatever the standard is. Yeah. But my point is that the state's liability is so much less. That's, I think, reflected in that $25 to $40 million.
But there are cases.
Exactly. Yeah.
States 2 million, as we've heard.
Yep.
Right.
Significantly.
Ben?
I appreciate this analysis. I would be interested in having some further conversations with the Office of Fiscal Analysis about what went into it. The two line items in the state budget that fund foster care and residential services total about $190 million already. That's in the FY26 budget. There's 124 for foster and 66 for short-term and residential. And so I can't imagine the cost would only increase by $25 to $40 million if state employees took over all of that work from the network of 50 or 60 providers across the state that currently hold those contracts. I don't know exactly how many staff it is off the top of my head, but it's hundreds that are currently in the nonprofit sector working in those programs, and it seems low.
Yeah, I think we can all agree. I think, once you start adding up the different segments, if the state did have to step in because these services were closed on the nonprofit side, I think we can all just add up and it would be substantial and unaffordable. So it really just emphasizes our desire to find a solution this coming session. So next meeting, we do have another broker coming, IMA, that's going to share a presentation with us. And then I thought we could really roll up our sleeves and bring some solutions that we could start crafting for a report that we put out that will be presented to the legislature for some options. Does that sound like a plan? Okay, and again, if another speaker comes up that we think is really important to have, we can always schedule that. I'm just trying to be conscious of the time before session.
I want, with your permission, to compliment not only you and your co-chair here, but this group. I thought of all the sessions I've attended, this was the most informative, the most interactive, and the most revealing. And I think revealing is the important word, Chair Wood, because at the end of the day, this is going to now funnel into a solution very rapidly, in my view. And it's going to be a solution which requires interaction and intervention by state government, or I don't know what I'm talking about after 50 years in the insurance business, and I think that I do. I think the critical thing is to remember something about how this insurance is purchased. This insurance is largely purchased as a package. Gentlemen, am I not right? It's like a chapter book.
Used to be purchases.
You go to chapter 1, you've got a property, set of property agreements. You go to chapter 2, you've got an automobile physical damage and liability set of agreements. You go to chapter 3, you've got primary general liability. Go to chapter 4, you might have some crime and employee fidelity. Am I right about that? So we must address contextually this crisis in the framework of how do we affect not just general liability, but the whole package and the way it's purchased by these organizations. So it includes more than third-party liability. It includes the delivery system of a chapter book. So next time we should discuss that in some detail, because that's what the issue is, I think.
Yeah, Michael really, I think, hit the nail on the head there. We have talked about so many things over the last few months, including the risk, and what that looks like, the state of Connecticut fingerprinting process. I mean, we could go through, the last, 10 meetings or so, and I think this is a really comprehensive solution that we're putting forward, not just one thing that's going to solve this whole business. And as we know, it will just pass as is, No, there'll be much negotiation. So, but thank you all so much. We have one more meeting. We'll do a presentation followed by a working group, working session, and then we'll see where it goes from there. Thank you to the speakers today. It was wonderful. Take care.